So we're talking today about the problems that we're experiencing with inflation and recession. The combination, of course, is called stagflation. So the recession part is the stagnation, the first part of that, and the inflation, of course, is deflation, the second half. It's just an odd mix, and it's kind of a lead-in. There's much more going on, but it's kind of indicative of the problems that we're facing in terms of going into an economic downturn, coupled with those higher prices. This is not the norm. This is not the standard. Okay? So what we're hearing on the political front, it's pretty standard, pretty common. It's a term called jawboning. Again, I've indicated here it's a technical term. It's some half joking about this, but it's the standard so far as political leaders are concerned. Officials stepping in and talking about whatever that topic might be. The economy is not growing fast enough, so just by talking about it, by jawboning is the expression, you're going to be able to improve the economy in some way, shape, or form. There's nothing new here, and the latest, of course, is with President Biden, but it goes back through, of course, through President Trump and going back through Obama and Bush and Clinton, and et cetera. And it goes. There was a rather famous time with Harry Truman, where he was doing his jawboning there was an issue with the steel manufacturers, and he was out there doing his political best to kind of steer the conversation, the economy, in the direction he wanted to go to. Anyway, that's pretty straightforward. So, example with President Biden, of course, I'll quote it. My administration is going to continue to do everything we can to lower prices for the American people. And the authors of the story indicate that the president's policies, his deals with the private sector, regulatory actions, and public jawboning, using the term jawboning, have failed so far to stop prices from marching upward. And yes, they continue as we speak. So speaking of which, just wanted to kind of walk through that first piece that we talk about in terms of the stagnation. And we saw in the first quarter of 2022 that the economy shrank by 1.4%. So that's the first quarter, January through March 2022. The second quarter will be, of course, April through June of 2022, and we should know more about that in the beginning of July. They come out with the first estimates. And, kind of the unofficial, official, traditional way of looking at a recession is that 2 consecutive quarters of negative real GDP growth. So, having said that, if we end up with a second negative quarter, that would certainly at least be, again, nominally considered to be a recession. The reality is that the recessions themselves it's a more complicated process that it goes through the channels with the NBER, which is the National Bureau of Economic Research, and they actually vote on that. But we'll stick with our 2 negative quarters, okay? So the second piece of that stagflation comes in terms of inflation. So the inflation, of course, we've seen quite a bit of inflation, and in May it was up to 8.6%. And so what that means is that there's a 12-month look back, if you will. So it would be June 2021 through May of 2022. The overall price levels changed by 8.6%. And drilling down more specifically at the more volatile items, food and energy, food was up 10.1%. Energy was up a whopping 34.6%. So bear this in mind. The discussion has been that we've pretty much topped out so far as inflation is concerned. Having said that, that may well be the case, and it may come down going forward. But remember, even if it's at 5% inflation, that's still inflation. It's just at a lower rate. It's a term we use as disinflation, going from one period to another. Okay, so just kind of keep that in mind. Inflation is with us. and it shall be for some time to come. So looking at the timeline here, if you will, of inflation, the CPI is the Consumer Price Index, and that's our typical measurement of inflation at the consumer level. So this is what the consumers are paying. And we're all consumers, so this is what we are all paying, as opposed to the Producer Price Index, that would be the firms. But at any rate, again, with the CPI, or the Consumer Price Index, we go back to May of 2020. Just think COVID and whatnot, it was at 0.2%. But even as late as January 2021, at the start of President Biden's term, it was at 1.4%. Since that time, in the subsequent months, going from January 21 through May of 2022, it climbed to 8.6%. My goodness. So we'll be getting into the particulars in a bit, but this is a massive, rapid change in prices, increase in prices. So again, this is another time period. We're looking at a longer time frame, I should say, going back to the early 2000s. So we've seen some ups and downs so far as inflation is concerned, but this has really taken off for us on the far right, of course. So what that consists of, that CPI, or that Consumer Price Index, all items, meaning everything goes in there, including food at home, all of these items, medical care, etc. These are all measured, if you will, on a regular basis. And at any rate, what we've seen here is a massive increase way over to the right. And aside from that, we've seen since the Great Recession, going back 2008 or so, inflation has been pretty moderate, and even going up into going into COVID, where we see this next recession, inflation has been moderate, and coming out of that recession, coming out of the COVID experience, if you will, it has really elevated. Lots of reasons for that, but again, pictures do speak loudly, do they not? So we just talked about the Consumer Price Index, and the Producer Price Index is what the producers, the firms, the companies, the businesses are paying for their inputs. So their inputs would include everything, all of the goods, and we're talking about in this case, meaning the whether we're talking about the diesel fuel or the labor, et cetera, all these things basically flow into this, into what the producer has to pay, of course. And so we saw in April of 2022, the Producer Price Index, producer price level, was at 11%. In May, the numbers had just come out before I put this together, but they did come down a bit, but they're still quite elevated, double-digit wise, anyways, for the month of May. So they're still quite high. So again, going back to the left, going to previous months. So we're looking at April 2020. This, of course, is during COVID, and the Producer Price Index was actually negative. That's not uncommon. We have seen negative numbers on both the Producer Price Index side and also on the Consumer Price Index side. So that would be deflation. And of course, starting again January 2021, the PPI was at 1.6%, quite low, if you will. And it's just skyrocketed, gone up to that 11%, or at least 10 point something percent from May of 2022. And again, when we're looking at these price increases, we have to kind of focus on what it is we're talking about. We're really looking at the supply side in this case. We're looking at what is called cost push inflation. The price is being pushed at the producer. The other side that we already talked about, the CPI, that's more on the demand side. That's what's called demand pull inflation. And so we were seeing quite a bit. And what happens is with the PPI in general, not always the case, depends upon how competitive markets are. Much of these costs are passed on to the consumer and end up being passed forward into that CPI, into that consumer price index. So now when we're talking about how we address the problems with inflation, the go-to, of course, is the Fed, the Federal Reserve Board, and more specifically, its monetary policy authority maker, if you will, is that Federal Open Market Committee, or the FOMC. And so they are the folks that, through the influencing of interest rates, they can help to spur on economic growth, or to, of course, to slow down economic growth. Restrictive monetary policy slows things down, and that's the one that we're going to be focusing on. So the Fed has a tremendous amount of power in terms of putting the brakes on the economy. And I have note here that we're looking at two different types of inflation. I already mentioned before about cost push inflation, that going into the producer price index, if you will, and the other side going to the consumer through the CPI demand pull inflation. So the Fed, regardless, in both instances, both cost push and demand pull inflation, they're very powerful in putting a stop to both of these, okay? But this is where there's a departure. They are extremely effective in terms of both, in terms of stopping them. The problem, of course, when we're talking about cost push inflation is that has to do with policy that, the underlying problem has to do with policy coming from, we'll just stay at the federal level, with the executive branch, with the presidency, or with Congress, okay, with the House of Representatives and the Senate, implementing policies that have the most impact, or the more permanent impact, if you will, on this cost push inflation. So the Fed can come in and stop this, but the problem, of course, that we're talking about, like in terms specifically about energy, we'll focus on that. It also has to do with the labor portion as well. Higher cost of wages, wage inflation is pushed to the firm, driving up prices, but certainly energy in terms of diesel fuel, for example, or for that matter, the production of electricity. The energy prices have certainly gone up, and this is that cost push side. And the Fed, again, can rein that in by slowing down the economy, stopping the economy. So if you stop the firm from producing, then yes, it's going to reduce cost push inflation. But the economy comes back around, you have the same issue unless that's dealt with, again, by the executive branch or the legislative branches. The flip side of this, or the other side rather of this, the demand pull inflation, the Fed has a tremendous amount of power, again, in both categories, both cost push and demand pull, but it's more suited for demand pull inflation, because demand pull inflation is something that we're all very familiar with this term, and that is that there are too many dollars chasing too few goods, meaning that you've got more money and you've got fewer goods available, for example. So what you have in essence is like a bidding war, an auction for those goods that are being sold. So if you're selling, the demand for vehicles is, we'll just throw a number out there, 1 million units, but there are only 500,000 vehicles available for sale. What's going to happen to the price of those units? It's going to go up, right? It's going to increase. And what's fed this process, what's aided and abetted, if you will, this process has been the extra money, if you will, that's been sloshing around, through such things as the stimulus payments. The San Francisco Fed, for example, said the last round of stimulus payments were responsible for probably about 3% of that inflation out there, the CPI, that consumer price index, the demand pull inflation. So the Fed can, again, stop this, and they're very powerful in stopping it through their open market operations by driving up interest rates. And I won't go into the particulars of how they go about doing this, but let's just say for argument's sake, the Fed is going to be quote unquote raising rates. They're not really raising rates. They raise the targeted Fed funds rate, but for our purposes, they're raising rates. So they raised rates most recently, again, May 5, it went up to 1%, 0.75 to 1%. That's the band that they're looking at. In essence, again, that it's gone up to 1%. And since that time, it's gone up to 1.75%. I don't have it on here, but it has gone up, and that was set in June. So the Fed meets every 6 weeks in their open market committee, and they voted, in essence, to drive up these interest rates. So they went from 1% up to the 1.75%. Here's the question, or here's the scenario. So who likes low interest rates? Consumers for sure. All of us like to borrow, So we like to borrow at very, very low rates. And the same for firms, for businesses. They like to borrow low rates. So the Fed drives up rates, it's going to what? Drive up those borrowing rates for consumers. And it's also going to increase the rates for firms. Now, consumers are easy to understand. Firms are also looking at this, and what causes them even further concern is knowing that the Fed in the past doesn't just raise rates once or twice. They have a regime of rate changes, meaning they're going to increase rates in probably a steady manner. Meet every 6 weeks, but they'll likely raise the Fed funds rate, as it's termed. That's the rate from which all other interest rates kind of flow from. If they're likely to raise interest rates every 6 weeks for probably the next few months. They may take one of these off and not do something, but in all likelihood they'll raise interest rates quite a bit from the current 1.75%. So as we've already pointed out that the Fed has a tremendous amount of power slowing down the economy. And again, the reason that they're intent on doing that is because of this inflation, the problem that we're experiencing with this inflation. Will that work? Yes, they know how to do it. They're quite adept at, did they wait too long? All these other questions come into play. And that's something that in some ways it kind of goes without saying. But at any rate, the Fed is on that path, if you will, to drive interest rates up. So here's the problem that they're going to run into. And this is the connection that the Fed really has not had to deal with this to any degree before, at least not that I know of. So first off, they've got two problems, as I note here. They must tamp down this inflation aggressively, or it will spiral out of control for sure. And secondly, it must not keep those rates high for any length of time. The reason for this has to do with our federal debt. Our wonderful federal debt is at $30.4 trillion and rising, probably to the tune of at least $700 billion this year and moving forward to that level and perhaps even more. And we'll get into this. I'll get into this in greater detail a bit here. But anyways, the idea is that currently we're servicing that debt. The interest payments on that debt amount to $500, $600 billion a year, okay? And the average maturity of that debt is around 5 years. It might be a bit longer, but roughly speaking, about 5 years. Meaning that over the course of 5 years, that debt will be turned over, all right? So that debt that we're talking about ranges treasury bills, notes, and bonds. So these treasury securities ranging from 30 days up to 30 years. So the point is that the question, I guess, is, are we going to pay off this debt? No, we're not going to pay off this 30.4 trillion, 31 trillion, probably by the end of 2022, and marching onward going forward. Are we going to pay off this debt? No, in fact, we're going to incur even more debt. We're going to experience more deficits, if you will. So we could get into the discussion as to whom do we owe the debt and so on and so forth. We'll get to that in a minute just for clarification's sake. But the idea, again, is that we have to service this 30 trillion plus dollar debt that's out there, okay? And again, the average maturity of that debt is about 5 years. Keep that in mind. So what we're looking at here is just a real quick look at what we're paying so far as that interest on the debt is. And remember, when I say we're paying this interest on the debt, this is something that has to be paid every year, meaning that this has to come out of every year's federal budget. There's a line item specifically for payment of interest on the debt, right? And this is always something that comes up when we start talking about raising the debt ceiling and holding budgets hostage and so on and so forth. This is the one that's out there. And the reason that this line item in particular is very important, and we'll get into this in greater detail, what the ramifications are, so on and so forth going forward. But keep in mind that the U.S. Has always paid their debt, paid their interest on their debt, without fail, if you will, going back to revolution times, Revolutionary War. It may have been post-Revolutionary War, but the point again was that this is something that we have a long-standing record of paying making our interest payments and not defaulting on our debt, which pretty much every other country has done on more than one occasion. Think about it. Even the likes of countries like Germany, France, Japan, right? They've all defaulted on their debt to one degree or another. The U.S. has never done that. So this is something that, so when we hear these discussions about, whether or not we're going, if we don't increase the debt limit, then we're not going to pay the interest on the debt, we're going to go into default. Those type of discussions come up, and that is an absolute no-go. We have always paid the interest on our debt. So this is also keep in mind that this is also the driver behind that the U.S. Treasury securities are considered zero risk, no risk, because again, we've always paid the interest on our debts. Keep that in mind, okay? So further looking at the same items here, we're looking again at $30.4 trillion in debt and the payment on the debt. And what you'll notice there, the interest payments on the debt. You notice the interest payments on the debt have actually come down. And that has been driven by what? This goes back to, there's more discussion here, but the point is that the actual interest on that debt that's being paid on that debt is very low. It's currently at 1.5%. So with it being at a very, very low rate, that's of course good for us in terms of repaying that debt, or I should say servicing the debt, not repaying the debt, but servicing the debt at very, very low interest rates, relatively speaking. So keep in mind now, if the Fed drives up interest rates, when I say they're driving up interest rates, that would also, driving up the Fed funds rate would necessarily drive up the interest on the debt, as kind of going forward. So keep that in mind. So the U.S. Treasury debt that's out there, that $30.4 trillion, if the Fed drives up interest rates, that would necessarily drive up those interest rates. So it's not far-fetched rather to see, again, we've got about a 5-year average maturity, meaning that the debt rolls over every 5 years. It has to be refinanced every 5 years. So if we have interest rates at 1.5%, it could very easily be going up to much, much higher levels, to 3%, to 4.5%, doubling, tripling. And of course, what that means is that those payments on that debt are going to what? Double, triple as well. And remember where those payments on the interest on the debt has to come from. It has to come out of the current federal budget, okay? So the question again kind of comes, okay, so these interest rates could go up, and the current it's at 1.5% overall total. So what's been happening? So if we go back to the beginning of 2021, for example, the interest rates, of course, were very, very low. And you push forward to January of 2022, they've gone up quite a bit, but nothing compared to where they're at now. When I say these rates, this is the what's termed the yield curve, if you will. U.S. Treasuries, meaning the yield curve, meaning going out from very, very short term, that 1 month, 30-day Treasury security out to that 30-year Treasury bond. So going from the bills to notes to bonds. And of course, what's happened is that those rates have gone up. So part of it, of course, has to do with the Fed driving up interest rates, but it also is reflecting what those rates reflect since these are zero risk rate instruments, Treasury securities, right? So what is all this? What's driving up the rates? What's driving up the rates again? Is the Fed driving up the rates? The Fed is driving up the rates because of what? Inflation. So this is reflecting that inflation, those higher rates in these U.S. Treasury securities. And again, they may seem like they're extremely low, and they're not high, but nonetheless, it's when you're starting at 1.5%, moving up to starting with looking at the 10-year bond, for example, the 10-year note. So in January 2021, it was at 0.93%, extremely low, 0.93, less than 1%. This is a 10-year note. Moving to January 2022, it had jumped up to 1.63, which is kind of moving toward a more normal range. But we're not interested in that. What we're looking at is what happens next is June of 2022, it jumps to 3.43%, kind of the traditional, the typical, I don't have the numbers in front of me, but that would have been probably a normal rate. Problem being that is what? Driving up those interest rates, those overall interest rates for the Treasury securities, bills, notes, and bonds, which of course is going, if those interest rates go up, that means the interest payment on the debt is going to go up as well, okay? So what we're looking at here is a distribution of that debt, that overall debt, that $30.4 trillion. And again, the latest numbers I could dig up would be about 62 months, the average maturity. Again, that's the bill over 5 years, maybe as high as 6 years, I'm not quite sure. But it's not that long. It wouldn't take interest rates very long, high for very long to drive up those rates. At any rate, the composition of that, the distribution of that debt, if you will, if you look at it, the lion's share of it, the biggest piece of it is in notes. Notes are denominated from the maturities, I should say, going from 1 year out to 20 years. The majority of these are 10-year. 10-year has become kind of the instrument of choice out there for whatever reason. The other large pieces of this, if you will, the next largest one were government account series. And what those are, that would be such things as that's close to, I think, about $6 trillion. That would include such things as the Social Security Trust Fund and so on and so forth. At any rate, this is a kind of a look-see at that. So remember what we're talking about. So we're looking at about a 5-year maturity, average maturity. We're talking about 1.5% interest on that 30+ trillion. 2 years' time, that 30 trillion is going to be $32 trillion. So the interest, again, going from, we'll just say, $600 billion a year on the 1.5% and doubling to 3%, which is absolutely foreseeable in even 2 years' time, maybe 3 years' time. Doubling, so we're looking at what? We're looking at payment on the debt, interest on the debt in the range of $1.2 trillion, we'll say, roughly. Remember, that has to come out of the current budget, which of course is going to do what? It's going to drive up the deficits, or should say, drive up the debt even more, end up with increased deficits as a result. So again, this is our This is our example of our weighted average maturity, just a picture of it, how it's moved over the years. And again, the latest data that I have is at the end of 2020, and I think it's a bit higher than this. And this was at 64.6 months, so a bit over, going on 5.5 years almost. And this has been driven, at least in part, by a major drive by the Treasury to push 10-year notes, 10-year Treasury securities, 10-year notes. At any rate, this is again just a picture of that. So there are all kinds of ways that the Treasury kind of looks at this debt, servicing the debt and so on and so forth. It's kind of interesting. So on this left-hand side, how have interest rates on the federal debt changed? And the interest rates, of course, have gone down. They've gone down, and the rationale behind this is, I'll go ahead and say it, such things as the quantitative easing, which is basically the Fed, the Federal Reserve, buying lots and lots of U.S. Treasury securities, and that, of course, would drive interest rates down because prices go up, interest rates go down. It's that inverse relationship. What I mean by that is that the Fed has had a major role to play in these interest rates being, artificially low, I guess you'd say. Typically, you can go back. Rates have been higher, so again, they're quite a bit lower. Nonetheless, what's happened is that if you look on the right, how much is that debt costing? The actual cost to maintain that debt, the interest payments on that debt, has actually gone up. And that's because the overall debt, of course, has risen dramatically up to this 30+ trillion. Most everyone out here that's looking at this or listening to this has seen the debt rise from, we'll say, $5 trillion. It was not that long ago that we were looking at a $5 trillion or less debt, and we're up to 30+ trillion, and does not appear to be much of an end in sight so far as that is concerned. So this is, again, why it's triply important, okay, that we have to, interest rates have to come down very, very quickly in terms of the Fed causing interest rates to drop very quickly, because we cannot, the unsustainability of this is just very, very clear. Interest rates double. It's going to drive the payment on the debt. It's going to double the payment on the debt and more, because we are also what? Incurring even more debt. So it's foreseeable that if we have any length of time, we could double the payment on the debt from this, 550 billion, we'll say, up to 1.2 trillion or higher if we incur more debt along the way, which of course we would have to do in order to service the debt. We're borrowing, and this is the danger part, is we're borrowing to do what? We're borrowing to afford to pay the interest. Not a good place to be. So this is just for kicks, if you will. What you'll notice is that the top 10 owners of the U.S. debt, 10 trillion are U.S. investors. U.S. investors would be primarily, we're talking about corporations, individuals buying debt, U.S., so domestically. So the good news is that we owe this to ourselves, most of this debt that's out there. The bad news is that we owe most of this debt, period. This is a problem. At any rate, so the Federal Reserve owns a huge portion, and this is going back a year ago, and the Fed's position has risen high, gone above, well above 5.3 trillion. But at any rate, 5.3 trillion Social Security, and then we see Japan popping in, and we see China at about 1 trillion, 1.2, 1.3 trillion. And they kind of go back and forth, Japan and China. And part of that, of course, has to do with trying to keep their currency devalued, the way depreciated, however you want to characterize it. It's actually devaluation, but that's because they have fixed prices. And even though Japan supposedly doesn't, they are very, they get very much involved in managing their foreign exchange, the Japanese yen. China does, of course, as well. So the point being is that you buy something in the U.S. and you pay for it with U.S. dollars, and those U.S. dollars go to Japan or China. So it goes away to Japan or China, and of course, what that means is there's an increased supply of dollars. So how the heck can Japan or China insulate themselves, protect, or how are they going to be able to keep the dollar strong so that they can continue to sell things to the U.S. customers? The way they do that, in part, there are others as well, but is to buy U.S. Treasury securities. So they park their monies, if you will, in these U.S. Treasury securities. They buy them, and that essentially sidelines all of that cash, all those U.S. dollars that are out there. Anyhow, the other thing is just a real quick takeaway. Of course, UK would be up there just because of the banking part that comes into play. And Ireland, it's interesting. Ireland is there primarily because it is it's kind of the home, if you will. A lot of corporations have made that their headquarters. And remember, keeping in mind that the U.S. Treasury securities are considered a no-risk investment. So if you want to park your money somewhere, you can park them in U.S. Treasury securities, and you feel fairly comfortable, or very comfortable, at least up until now. It's getting a little bit shaky, I think, but who knows? Anyway, that's kind of the story, who owns that debt that's out there. Good news is that we own most of it. The bad news is that we own most of it, but there are still quite a few foreigners that own something to the tune of about, I think, $7 trillion, I want to say, out of our 30 trillion are owned by foreign interest. Okay, so again, kind of elaborating back on our point being that, first off, everyone knows that we run deficits. We have been running deficits, especially going through COVID. Several $1 trillion of deficits have accumulated, adding on to that debt. Remember, the difference is the deficit is how much you spend from the fiscal year, which runs from October 1 through September 30 the following year. And the debt is that overall the accumulated deficits, we'll just say, because we have not run a surplus for 20 plus years. At any rate, so what we're looking at here is that we're spending more, of course, than we are taking in. What's interesting to note is that the government receipts have actually kind of increased quite a bit. But again, because of the shortfall and because of the problems that we're talking about, the Fed driving up interest rates, this is what I'll just call it the debt bomb that's out there, that's facing us. And we are challenged enough as it is to rein in spending, if you will, so far as our budgets are concerned. And if interest rates, again, tack on another $500 billion onto these spending. Again, that $7 trillion expenditures, a lot of this still has to do with COVID. It would come down. But nonetheless, we're still spending more than we're taking in. So this, again, exacerbates that problem that we were talking about, because if the Fed keeps the interest rates high for any length of time, U.S. Treasury securities, U.S. Treasury, the interest on that debt is going to go up significantly. And again, servicing that debt, paying the interest on that debt, that has to come out of the current budget. And if spending doesn't change, if the receipts don't change, that means that we would be just tacking on another $500 billion, we'll say, onto that deficit. So these are words of caution. One is that that's kind of where we're heading. Two is that we can't really go there. How about that? So we've been talking about the Fed, focusing on the Fed in terms of monetary policy through its monetary policy uh, authority. That would be the Federal Open Market Committee and driving up interest rates and so on and so forth. And I'm hoping that we've kind of made it clear that while the Fed can do this and will do this and really has to do this, drive up rates and in essence driving us into a recession or something along those lines, they can't do it for very long. And the reason I say that is that one, because of those the debt bomb that's out there, interest rates on the debt rising significantly, and on top of that as well, when we're talking about if we go into recession, that's going to what? It's going to increase government spending. It's going to slow down the economy. It's going to put people out of work, cause a lot of trauma, and cause us to spend even more. So it has to be two things. It has to be fast. It's going to be painful no matter what. It has to be fast, and we've got to turn this thing around very, very quickly. The other part, so we focused on the Fed, the Federal Reserve, the FOMC, the Federal Open Market Committee. The other part of this is that I talked about before, at the federal level, we're looking at the executive branch, president, and we're also looking at the legislative, Congress, right? House of Representatives and the Senate. So two things, at least on so far as the supply side is concerned, the cost push inflation. One has to do with wage inflation. So wage inflation, we've had people laid off, or I shouldn't say laid off. A lot of people had fallen out of the workforce because of due to COVID and so on and so forth, right? Everyone is very familiar with that, painfully familiar with that, everything that happened with COVID. But what we notice is that if we go back to this labor force participation rate, this is something to just illustrate what the problem is. So if we go back to February of 2020, the labor force participation rate was at 63.4%. Here we are in May of 2022 with COVID pretty much in the rearview mirror. Not to say it's not going to be around, but we've learned how to deal with this. Labor force participation rate being at 62.3%. Problem with this is that even at 63.4% in February of 2020, that was low relative to the higher rates. A lot of reasons for it. Nonetheless, what I have to say is that we have, even at that 63.4%, there were several million people on the sidelines that were out of the workforce. So let's step back. When I say labor force participation rate, that means that we're looking at the labor force, and the labor force is equal to those folks that are employed and those folks that are counted as what are called U3 unemployed. In order to be counted as U3 unemployed, you have to be one, not employed, not working, right? Secondly, you have to be actively seeking employment. So that labor force is equal to the employed plus those folks that are not employed but are actively seeking employment. And that's the numerator. The denominator is the civilian non-institutional population. So the civilian non-institutional population includes the labor force, the aforementioned labor force, right? The employed plus the unemployed, but also those folks that are not in the labor force, but are also the folks that are I should say, it excludes the institutional population. The not in the labor force, we'll just focus on that. That would include people that are on the sidelines for whatever reason. It would also include senior citizens, people that are retired, so on and so forth. So as the baby boom continues to roll through into their golden years, into retirement years, that has caused it to come down somewhat. But the reality is, and this is for another conversation, it's a lot lower, the labor force participation rate. It's a lot lower than it really, really ought to be, and to the tune of anywhere from 5 to 10 million people. So what that means is that all we know, all we hear about, all we see is that there's a labor shortage, meaning that the jobs are available, but people aren't filling those jobs. There are more jobs available than people. So of course, when you've got more jobs, more demand than there are people, that's going to do what? Be inflationary. So we've seen wage inflation as a result. So this is something that is very, very much of a problem. So how do we resolve this problem? Part of it, at least a good portion of it, has to be done in terms of policy. Policy coming from, again, Congress, executive branch, what have you. Meaning that, what is causing people to remain on the sidelines? There's an expression called in economics called reservation price, and I'm not saying this is where everything is at, but it certainly adds to the problem, and that is that, let's just say, for example, and unemployment insurance and so on and so forth. Think about it this way: $15 an hour is what the wage is for whatever we're talking about. $15 an hour. And you are being supported with programs through the government, whether we're talking, whatever it might be. It could be Medicaid, it could be some type of unemployment insurance, or it could be some sort of welfare payment. And it equates to about a $10 an hour income, if you will. It's not income, but monies that are flowing to you, flowing through to you. So you've got to make the decision as to whether or not it's worthwhile for you to go back to work. Meaning that, is it worth for you to be paid $15 an hour to actually net what, $5 an hour? Is that $5 an hour worth it to you? And then when you start thinking about such things, and I'll throw this in there, such things as like childcare, and that's a legitimate concern, cost, et cetera, major concern. But again, the takeaway is that there are massive disruptions within our labor force, our labor markets, that could probably be handled better. I'll leave it at that. Have to be handled better. And this has caused what? A great deal of wage inflation. Just it's been extremely, it's wreaked havoc on the economy, as all of us know. So the next piece of this is a much more direct look at things, I should say. When we're looking at the cost push on the side of the supply side issues that we talked about labor. Now we'll just focus a bit on energy. So more specifically looking at, this is a no-brainer, an easy thing. So if we look at March 2020, as we're going into going into COVID, March 2020, we were producing 12.8 million barrels a day. Phenomenal, actually, but that's neither here nor there. So we had ramped up production, of course, prior to this. We reached that point of energy independence, not so far as the crude oil is concerned, because we of course use more than 12.8 million barrels a day in crude oil. I think it's probably closer to 18 million, but that's neither here nor there. Overall, we were energy independent in terms of like natural gas and coal and oil, for that matter. At any rate, so we're producing 12.8 million barrels a day. And here we are in March of 2022. This is coming from the U.S. Energy Information Administration, the EIA. March 2022, we're down to 11.7 million. This is why this is something that defies reason. This points to different, these are policy. This is all, it points to policy. And whether we're talking about, when I say policy, it's not just with the pipelines and so on and so forth. It's putting the onus on the fossil fuel industry, and you're going to be gone, so why invest? Different things that are out there, different initiatives that are out there, whether we're talking about from the government putting the kibosh, if you will, on the production of crude oil, to the private sector really doing the same, and opting not to invest, and encouraging not to invest, such as these things like I think it's called the ESG, there's an initiative that's out there, but that's for another discussion. bottom line is this. We've gone from 12.8 million barrels down to 11.7 million. That is a major part of the problem that we're experiencing with this, with these massive prices that we are currently experiencing. This massive inflation, the 34.6% inflation in terms of energy year over year. So when we drill down, the crude oil, of course, is the refined products that come from crude oil that we use range from gasoline to kerosene to diesel fuel, gasoline for our vehicles, most of our vehicles, yes. Not everybody has an electric vehicle. I don't mean to be, to try to sound funny about that, but gasoline powers most of the vehicles that are on the road. Certainly most of the non-commercial vehicles are gasoline driven, right? Diesel, and also remember, diesel is for trucks. Kerosene is basically jet fuel. So guess what, folks? Paying more for price at the pump for gas and diesel, but we're also paying much, much higher ticket prices, if you will, for air travel. So gas prices, low point, of course, April 2020, $1.94. This is for all grades, just a combination of all grades, regular, all the way to premium. So $1.94, of course, this is during COVID. January 2021, it was at $2.42. Gone up a bit, but pretty reasonable. And of course, May 2022, $4.55, and it's even higher today, of course. This is the overall average. Again, the numbers are coming from the Energy and Information Administration. So this next piece is really the troubling part. I should have also included the jet fuel, but that's perhaps again for another discussion. But for diesel, of course, all of us are impacted by diesel prices. October 2020 was at $2.39 a gallon. January 2021, $2.68 a gallon. And of course, May up to $5.57 a gallon, and well over $6 a gallon on average in June of 2022, certainly. And the problem with this, of course, is that it's one thing for the consumer, people driving their cars and so on and so forth, but it's also another for any kind of transportation. Ultimately, trucks deliver pretty much everything. I know we've got trains and we've got pipelines for different fluids, but when we get to the delivery to retail establishments is typically through via truck. There's no way around that. And if those costs go up, and they've gone up significantly, that's going to drive up prices, and it has. Prices have gone up significantly. This is the cost push side. This is where we have to get our head together so far as policies are concerned. At any rate, this is, again, just wanted to walk through that. So just kind of wrap things up here. The critical piece to this, of course, is the Federal Reserve. Will they be able to slow down the inflation? Yes, they're adept at that. This is what they're designed to do. And yes, they will be able to slam in the economy, to reduce inflation. Are we going to be able to avoid recession? No, I don't think so. Probably in a recession now. I'm not trying to be cavalier about it, but that's kind of the reality. If maybe we're not, but I'm thinking that we are in a recession as we speak right now. The real critical piece is how long will we be in that recession? It can't be very long. We can't have this go on for very long for the reasons that I talked about before. If we're in an extended recession, of course, that means that government spending is going to increase. The government receipts, the taxes would go down, and all of this is built on that whole idea of the Fed driving up interest rates, higher interest rates, the economy going into recession, and the Fed turning back around and driving those interest rates down to get us moving again. That soft landing that we all hear about ain't going to be soft, I don't believe. Meaning it has to be fast both ways, fast going down and fast coming back, in order to salvage this whole idea that I put forth about those interest payments on the debt. That has to, that is truly the piece of the pie that that we cannot tolerate for very long. Higher interest rate on the debt, or for that matter, for a recession to continue for a long period of time, because both things come into play: increased government spending, reduction in tax revenues, and also I should have said this as well. The last piece of it is that those interest rates rising on our overall debt. So anyway, stay tuned. More to follow. Hang in there, everyone.